good morning or good afternoon, wherever you may be located, throughout the country. But we appreciate you tuning in for our weekly Pro Perspective here today. We have some great guests. I'm probably a little bit biased if you've heard any of the conversation so far. I'm originally from Chicago and have seen the performance of both these Austin and Sean today. So we just want to take you on an insider's look to all things commercial real estate related. So I'm your host, Steve Narish. I'm regional director for the central part of the United States here at Crexi. And today we have zoomed in Austin Weisenbeck with Marcus and Millichap and Sean Sharko with Marcus and Millichap. So we'll provide a brief introduction. They certainly have a very storied and successful career as a commercial real estate broker. But Sean Sharko started with Marcus and Millichap in 2004, and then Austin joined in 2007. They were both working in the Chicago and Oak Brook, offices within Marcus and Millichap, and decided to join as a partnership in 2009. So they specialize in multi-tenant and single-tenant net lease retail assets, along with medical investments throughout the Chicago market and nationwide real estate as well. They represent corporate, private, institutional level clients in really the disposition and acquisition of investment properties and underutilized assets. Really, they've based on their success, you can tell by the number of transactions they've done over the course of their career. They've exceeded 639 transactions across 31 different states nationwide, with a total value of nearly $2.4 billion. So together, in this joint effort, they're dedicated to growing their team and their brand, and continue to expand their reach in the retail and medical investment field and property marketplace. For all the attendees, obviously they have a vast amount of experience both in Chicago, but just as importantly nationwide, with the amount of transactions they've done nationwide. So thank you very much, gentlemen, for joining today. We appreciate you hopping in and speaking for the audience.
Thanks for having us.
Now, as a quick logistical reminder for everybody who's joined, there's a question and answer box and a chat feature. So if you can ask any questions along the way, feel free, and we'll be sure to address those. But I will be monitoring the chat box, and we'll just be answering those at a few different times throughout the presentation. So why don't we just dive in here, gentlemen, just kind of going into both of your backgrounds, kind of going in, starting, I guess, at least the brokerage career when it first peaked, and then kind of migrated into, the great financial crisis and the market crash. If you could just help us just better understand your backgrounds and as it relates to how you got into commercial real estate brokerage. And we'll just start with that.
I'll jump in. This is a second career for me. I was actually a third generation restaurateur. So I was basically a retailer. I was out there interfacing with the public on a daily basis. And I was actually a tenant at different times, although my family also owned their own real estate at different times. So I got to see it from different perspectives. And the restaurant business is definitely a hard business. Gave me a little grit. But I also wanted to make a career change and saw real estate as an opportunity to do so. And I kind of went into it really knowing not only where I wanted to be after doing some interviewing. I wanted to be at Marcus & Millichap and aggressively had an interview to get there. But I also wanted to do retail. There was a big push for maybe me to do multi-tenant or multi-family, pardon me. But again, having the exposure as a tenant and then also having a little bit of family owning some real estate, retail was definitely the place for me.
Like Sean, this was a second career for me. I went to business school, but I got a little burnt out there. Decided to try to partner my my business degree with my love of film. So I moved out to LA, worked 3 years in the film business. Like Sean's experience in the restaurant industry, the entertainment industry teaches you to have very thick skin. It's a very tough business, very tough people. So when I moved to Chicago in 2005, I had taken some real estate classes in business school and really enjoyed what I had learned. So I decided to give that a shot. Marcus at that point had just opened the Oak Brook office and they were looking to recruit. So got an interview there, and retail was really the only product type that was of interest to me. And when I started, Marcus is big on mentorship, helping kind of expedite new agents' learning curves by encouraging partnering with senior agents. So Sean was the one that I ended up partnering with, and he had about 2.5 years on me, and had obviously some deals that he had done. So when I started, I kind of leaned on him to really help me in expediting my learning curve, which was great, and we just got along really well. And after a couple of years of him helping me out, we decided to partner up.
Yeah, great. Yeah, and we're officially live for 5 years this month in October at Crexi, and I've seen like just the dramatic growth and the way that you guys have created your brand, and you're one of our favorite clients to work with. But I think I can see all the success that you guys have had, so that's great. I have kind of a not similar background as Sean, but my father owned and operated some assisted living facilities, and he probably wanted me to take over the family business, but realized, after kind of spending some years in my upbringing, I wanted to go a different route. And also worked in the service and restaurant business too. Rosati's, at which you guys are probably familiar with. Sure. Knew the owners there, and waited tables and cooked pizzas and did everything to understand like kind of the retail industry there. We have a question here in a second, but we'll bounce to that one in just a moment for the person who just asked it. Why don't we start with our first topic, which would be what are you guys seeing in the current retail climate? Maybe a transition to what you were seeing prior to the pandemic. With e-commerce coming into the being in the picture. Like what kind of factors are you seeing in the retail transition as COVID helped accelerate things? And just tell us a little bit about what you're seeing.
Well, COVID definitely changed things, but good or bad, things were already changing in retail, right? They've been changing for a while. E-commerce has had its effect on retail for a good period of time. I think COVID really accelerated a lot of the things that were already happening. It kind of pointed out some of the losers and also some of the winners in the industry, or just highlighted them even more. But also, for the last several years, there's been a real focus on experiential real estate or retail, where people are coming and physically being present. A lot of focus on medtail, medical tenants who are in a retail position, or gyms. And obviously COVID has really had people rechange that thinking, where everybody was always thinking about, that's a safe spot to be, e-commerce resistant. Now they have to stop and say, how has COVID changed this, or how long is COVID going to affect us?
Okay. And what differences, you guys have dealt with different crises throughout your brokerage career. When you were, and I know you're maybe just getting into, brokerage when the first when the great financial crisis hit, but what differences do you see versus kind of what we're seeing now compared to, when the market crashed, 15 years ago?
I think, well, the big thing is the credit markets. When the great financial crisis hit, the credit market seized, debt was not available. Debt is available, maybe not as much for retail as it is, say, for industrial, multifamily, but, we've been really fortunate as a team, closing probably, at least 25, 30 deals since the lockdown started. And I'd say almost all of them have, had some component of financing involved. So that has been huge. When the great financial crisis hit and credit markets froze, there was no debt out there. So that really, put a stop to really any velocity that was happening in the transaction market. So, and I think probably the biggest thing that I see that difference-wise is, when the crisis hit, that kind of, a lot of people were digesting the reasons why and trying to understand why the great financial crisis had hit, all the derivatives and such, and the housing market, the bubble, all that, while this kind of this came out of nowhere, and it's a totally different type of, impact to our market and our industry. And I think, unlike the crisis, nobody really had an idea as to when that would end, and how potentially prolonged the Great Recession was going to be, versus this, which I think most would agree is going to be much more of a temporary issue and more short-lived. We're all waiting for a vaccine, and I think the general consensus is that when a vaccine hits, the market and our industry and really the economy should be on much better footing and should start to improve. So I think that's probably the big differentiating factors between this market impact versus the Great Recession.
I'm going to jump back to something Austin said, if you don't mind, and that's going into the debt markets. The debt markets are definitely much different than they were in the Great Recession, but also the leverage points. When we went into the Great Recession, there was many people were highly levered. Didn't give them a lot of opportunity to make decisions because they were kind of stuck. They didn't have refinance options. They had lender pressure. Here, people were in check. You know what? We went into this with a good head of steam. People were in check with their leverage points. There's equity in these properties. So even though there's some turmoil, people have the flexibility they didn't have before.
And I think lenders, to your point, is they're being more flexible. Lenders aren't looking to put the screws to landlords right now. I mean, for every landlord I know that is giving tenant relief, there's a lender that's giving landlord relief. So that's a big difference as well.
Yeah, I mean, that's a good point. I think, and just based on what you said, Austin, compared to the great financial crisis, is I think at first people had sticker shock when everything was first happening, but they do see light at the end of the tunnel, and it's a little bit, I don't think predictable is the right word to use at any point, because this is, I think, totally unprecedented, no matter which way you look at it. But I do think there's light at the end of the tunnel, and we're hopeful for, kind of this rebound, and we're already starting to see it at Crexi in terms of buy-side activity as people are looking at both to acquire retail properties and then on the lease front as well. We do have a question from the audience from Todd in Utah. He mentioned that they're seeing a lot of multi-tenant retail properties being rebuilt or converted into multifamily. Is this a regional trend, or are you seeing this nationally? Do you have any insights of you guys? Are you guys seeing this at all? Any feedback there?
If you're talking about multi-tenant, like maybe not a neighborhood shopping center, but more of a mall, which malls have been in trouble going into this, and malls are definitely in trouble now, where they're a huge site where, multi-acres, 20 plus acres in many cases. Absolutely, the ability to carve that out or repurpose parts or the entire site is definitely an adaptive reuse of the land. On smaller sites, no. I mean, neighborhood shopping centers aren't going anywhere. They're evolving, but they're not going
anywhere. Yeah, I can't, Sean and I are pretty Chicago centric, so I don't know that we could answer it from a national perspective, but regionally, yes, there's a little bit of that, but we've been fortunate to partner with some colleagues within M&M on some mixed use assets that have a multifamily component. But right now, multifamily in Chicago is actually really slowing down. The cost of construction going up. There was a lot of development, multifamily development in the city especially, and rents right now are under pressure, and occupancy is down. So, we'll probably address it at some point later in this discussion, but everything that's happening with the rioting and just a lot of crime and such in the urban markets, where Chicago has certainly seen an uptick in it, and we've seen a bit of a migration, more of a migration to the suburbs. So to that end, we might see more of this transition from retail into multifamily at some point in the future, but not really right now. And I think when it does it, it's probably going to be a bit more suburban focused than urban.
Okay. Yeah, we'll continue to stay on track, but there are a couple of questions coming in, so we appreciate the live audience participating and understanding these gentlemen's perspectives. So let's this kind of will allow us to transition into the next topic. But someone would like to know, what are the cap rates headed for retail in Chicago? What are you seeing? How are cap rates in Chicago looking? And then we'll move on to the couple other questions, but if we want to answer that one really quickly.
So that's a question we get, or all of us get every day. Where cap rates going? Best answer is it depends. It is an asset by asset answer, but overall, cap rates are actually staying where they were. In some places, maybe improving. The thing that's really changing is underwriting. What's your NOI? What's a defendable NOI? And then they'll go ahead and apply the cap rate from there. So, I mean, if it was a 7 cap before, it's still a 7 cap today, but it's really the underlying underwriting that's going into that 7 cap. That's a big difference in where all our conversation goes. If it's a single tenant CVS, that cap rate's gotten a little better. People are gravitating towards that product because it's very understandable. If it's a multi-tenant shopping center with mom and pops who still are asking for relief and or aren't open yet, that's a very different conversation than underrated. So.
And just because it's based on how you just answered, Sean, can you elaborate more on your you said, what do you mean by underwriting and how the strategies have changed maybe as it relates to underwriting of what, which I would think just how the underwriting strategies change maybe. Could you elaborate further on that?
Just understanding the tenant risk. Again, using the example, single tenant, very easy to evaluate the risk, very easy to understand, a CVS, a Starbucks, as opposed to maybe a one-off daycare operator. Different credits, easy to evaluate. Multi-tenant shopping centers, you really have to go tenant by tenant through the tenant roster. If you have a 10-tenant shopping center, you really have to go through, and that's where we spend most of our time today, is really showing investors the reality. Transparency is everything. Out of the 10 tenants, 8 are open, 8 are paying rent. Here are 2 who have maybe struggled a little bit. This one is actually paying rent. We think he's going to make it. This one here, we'll have to acknowledge that maybe he's not going to make it, and we have to take him out of the rent roll for the time being for underwriting purposes. So it's really just going through all the individual credits.
Okay. Are you seeing suburban versus urban, or in the city, obviously in Chicago, are you seeing more suburban retail as being less impact or less affected, and it's kind of continuing the way that it was prior to the pandemic, or what are you seeing versus maybe urban versus suburban retail?
I would say probably suburban is actually a little bit more sought after right now. I think the civil unrest in the cities is part of that. I think the other part of it is that there's more product available in the suburbs. I mean, urban retail, you just don't see the inventory like you do in the suburbs. There's more new construction in the suburbs, and there's just more velocity because people typically their hold periods are shorter in the burbs than they are in the city. Most city owners are generational type owners and just hold for a longer period. But I'd say as it relates to just demand. We're certainly seeing more in the suburbs now. Part of that too is, like I said earlier, we're very focused on Chicago, and the tax situation, real estate tax situation in Cook County can oftentimes be harder for investors to quantify that risk, and that is proven to cause more demand in the suburbs, or at least the collar counties as well.
Yeah.
Okay.
In the city, you also have high rents combined with the high real estate taxes. So the total occupancy cost on these net leases is higher. So more pressure on the tenants. And if the tenants are feeling pressure from COVID, which many are, that kind of trickles down to the landlords feeling a little bit of pressure from their tenants for relief. So, generically speaking, with lower rents, there's a little better operations probably in some of the suburban markets.
Okay, and then we touched base on e-commerce. I appreciate both of you jumping in there. But Cooper would like to know, you guys are all making my job a lot easier. But no, I'm just kidding. So what are you seeing from neighborhood shopping centers or shopping plazas that fail from e-commerce, and what can they be repurposed into? Do you guys have any insight there?
Retail's been evolving for a while, like I said. I mean, ever since the Great Recession, retail's been changing, and there's been a lot of innovation in our industry for a while. Medtail is the one that is really easy to point out. Seeing more dentists, more physical therapists, getting out of the 1- and 2-story office buildings that don't give them a lot of visibility, and they're backfilling those retail centers. Restaurants are still out there, although those footprints are maybe changing from bigger sit-down restaurants to more takeout type of concepts. But tenants and retail continue to evolve and be needed. We drive by these shopping centers every day, so we're all using them.
Absolutely. And then why don't we shift to we have some other questions coming in, and audience, we'll make sure that we get to those. But why don't we shift to the buyers focusing on the retail assets right now? Are you seeing do you see any trends in terms of buyer focus and what they're looking at, or maybe the way that they're shifting their needs and interest of what, like, their desirability, increases in square footage? And if you could provide just any type of things that you're seeing on the buy side, that would be helpful.
On the buy side, I don't know that it's too different than it was pre-COVID. I think buyers are maybe just understandably more cautious. To Sean's point earlier, the focus is all on the NOI. If it's a property they like, cap rate is secondary to agreeing on what the true NOI of the property is, and quantifying that cash flow risk. What's the true operating income here, looking at getting as granular as a tenant by tenant basis, who got relief, who made it through through the lockdown, paying rent as per normal versus the abatement or deferral tenants. So I'd say that's number one. And then just as it relates to who's active, even prior to COVID, it was a pretty bifurcated market. I'd say there was really two very active buyer groups. There were those who were looking for stability and low risk, which is the credit, single tenant, long-term, multi-tenant, new construction, where you've got national tenants that are easy to understand and the risk is mitigated and easy to quantify. And then there was the other camp, which is the opportunistic type buyer, which I'd say, if anything, that market's probably both have grown because of COVID. You've got the people who are looking for the true stable assets, and then you've got the others who are thinking that COVID has created some distress in the market and has grown that opportunistic type buyer pool. With debt still being available and interest rates being so low, you're seeing more of the syndicator type investors that are looking for that B, C class center that maybe had a little occupancy or cash flow issues that resulted from COVID, and they're out there actively, writing offers and looking to put money to work. It's a lot easier right now with interest rates in the 3s and low 4s to make sense out of a lot of these investments, and for them to a lot of them to pencil now a lot easier than they did even pre-COVID.
Okay, go ahead, Sean.
No, I think that the overall theme for both groups of investors, though, is long-term outlook. It's the investors who are looking past COVID and looking at this as this is going to be, a 5, a 10, or a generational hold, who are in the market looking at the inexpensive debt, looking at where cap rates were before COVID and are now, and that spread, and saying, wow, I can make a 12, 14% cash on cash. If I do have a hiccup, I got a little room, and in the long term, this is going to be a great hold for me. So it's really that long-term perspective, that investor who's going to be doing well in this crisis.
Okay, and as we touched upon before, I think everyone can kind of see that this is hopefully short-lived, and that's the way that you have to look at it when making these investments. And then I'm going to flip it on the opposite side. This is more on a personal level, but I know that you guys, focus on medical investments, medical office that, oftentimes can be classified as retail as well. But are you seeing the owners in the medical space eager to sell more right now, or have you seen that increase in terms of disposing of assets? Are you having more conversations with sellers in that sector?
I'd say we're having more conversations, period. I mean, that was a goal. That was a goal of ours.
Too many conversations.
Yeah, when the Great Recession hit, that was pretty much all you could do, was talk to people, because there weren't many transactions happening. So, what is nice is Sean and I both went through that, so we have a very good understanding of what needs to be done now, with another, albeit hopefully minor recession happening. But yeah, I mean, medical it's certainly very sought after. Before COVID, it was clearly internet resistant. It was necessity, which was a big word that was thrown around, prior to COVID, and now even more so. But yeah, I mean, medical owners, I'd say, are probably more apt to hold than sell right now, for the obvious reason, which is, lack of risk or minimized risk with the asset. The medical that we focus on a lot is dialysis, because a lot of retail developers do dialysis projects. And I'll say we're still evaluating a lot of them, but I'd say fewer are transitioning to potential new business than before COVID, because everybody wants stability, and those assets are providing landlords with a lot of stable cash flow right now.
Okay, we have a few questions here. I want to make sure that we get everyone's questions answered while we stay on time track. But what do you see backfilling movie theaters, or do you see a company like Disney purchasing a cinema for exclusive use for their own films, or like ESPN content? So this might be a little bit too detailed, but do you have any thoughts on how the movie theaters have being backfilled? Any thoughts there?
Yeah, I think you're going to see certainly a portion of cinemas not survive. I mean, if you're watching the news, you're seeing that Regal just decided that they're going to close. AMC, though, conversely, has said they're going to stay open. You're getting a lot of movies getting pushed to next year. And as kind of selfishly, as a lover of movies and cinema, I would hate to see movies chains go out of business. I think you'll see some, but they're probably likely to be smaller. But I also think at some point, I think the government is going to have to supplement that industry. Already there's talk, obviously, of with Trump recently tweeting about the airline industry and providing financial support there. I think the film industry is I'd be surprised if they don't see some, some financial support at some point from the government. But, there was rumors with Amazon maybe acquiring AMC during the lockdown. So, yeah, I wouldn't be surprised if some companies like an Amazon, like a Disney, maybe see some opportunity there and perhaps, target some of these companies for acquisition.
Okay.
And the ones that aren't reused as movie theaters are going to fall into the same camp as other big box that's failed. They'll be creative, adaptive reuse, maybe a little more expensive because movie theaters have, different logistics inside. But, whether it's a self-storage use or it's wrecked and, made into an alternative development, they're big sites and there's probably a lot of flexibility with those sites.
Yeah, conversion, that makes sense. How do you measure risk of buying a triple net property such as a Walgreens or a McDonald's with less than 5 years remaining in the lease but options years available? Marcelo would like some advice there.
You start going back to, really what we always say is after you get under 10 years, but you should be doing this at any term. You really have to look at the underlying real estate. But the shorter the lease, the more you have to look at the real estate versus the lease. Inherently, options protect tenants. So it's nice that they have them. But if that's an over-market option, I'm sure that tenant's going to have a conversation with you before they exercise it, trying to reset that rent. But it's going back to fundamentals. What's the rental rate? How does the tenant do in this location? Do they want to be in this market? Can they move? What's their alternatives? So you have to kind of be a boot on the ground and look at each site individually. It's not a coupon at that point anymore. When that was a 25-year Walgreens lease, that's a coupon. Yeah. That's a bond. Nobody can really see 25 years out. 5 years comes pretty fast. You better understand your alternatives. God forbid something happens there.
Okay, thank you very much for that. And I have one written down here because we got a question yesterday ahead of time, and I want to make sure that Rick's question gets answered. It looks like he's in a 1031 exchange starting in November. He wants an investment for the next 5 years with a good return. They have initial investment of about $1 million. And any feedback on what type of property they should focus on? Preferred low maintenance, low property management expenses, and interested in West Coast, but they're open to anywhere across the nation if it makes sense and has good returns.
Oh, you don't want to take this one, Austin? Okay.
No, I'll take this. $1 million, with $1 million investment, your options, if you're looking for something very passive, low maintenance, low landlord, few landlord obligations, I think you're looking at fast food, you're looking at auto parts, things of that nature, and
dollar stores.
I'm sorry?
Dollar stores, Dollar Generals.
Dollar stores. All three of which are concepts I personally believe very strongly in. They all did well during the recession. They all did well during COVID. Those are three, industries: dollar stores, auto parts, and fast food that I would highly recommend focusing on.
There you go, Rick. There's your take that and run with it.
We're happy to
other
represent
questions.
You too.
Say again, Austin.
We're happy to represent you too if you need a broker.
Yeah, we'll share the contact information. I got his email. I'll pass that along after the call here today. Sorry, there's a lot coming in. I think we got to the most of them. And what type of, and I know we already touched base upon this a little bit, but what type of retailer do you see growing, and what type of retailer is going away right
now? Hard to answer. So we're still kind of in it, and I think that, as Austin said earlier, that as we put COVID behind us eventually, a lot of what was working before will resurrect and come back. So I do think experiential real estate retail will be the future again. Right now, it's gravitating towards a lot of that necessity still. I always say Starbucks has been a big winner. It's definitely been where we've seen a lot of investor focus. Even during the shutdown where they couldn't have guests in the interior, they had their drive-throughs and they were busy and doing well. So again, to Austin's point, fast food, most anything with the drive-through is done pretty well, and that includes the drugstores. I think that, the tenants that are having a hard time are the tenants like dry cleaners. There's a good example of a tenant that, most of us aren't going to the office every day. Most of us aren't wearing a white shirt every day like we used to. And so that's going to change, that tenant pool is going to change dramatically. And one you have to look at a little more cautiously.
Yeah, that makes sense. I mean, I've only gone to the drive-through through these Zoom meetings, definitely not for in-person settings. But I can see that one changing for sure. How about someone with $10 to $20 million in cash, 1031? Any advice on where they should place their cash?
I was going to say this when the first question was asked. Beauty's really in the eye of the beholder as it relates to investments, right? It's a little bit of individuality as to what you believe in. Myself, and I won't speak for Austin, I like diversity. So I'd probably be splitting that up. Looking at some credit tenants, maybe a little single tenant, but then also if you can find the right property that you believe in. Like I said earlier, I think this is a long-term game. If you find the right corner, the right location, look for that type of real estate. I think I don't know if it's really a trend, but it's something that I've seen is between the Great Recession and then now this, a lot of generational owners have kind of had enough. They're at a point where they have the equity. A lot of these properties are paid off, and maybe they're at retirement age, maybe not, but they're kind of sick of dealing with problems or challenges. And so I'm seeing some really unique opportunities come to market here and there, or at least families or holders say now's the right time for us to actually sell the property. And so I think there's some unique opportunity. You're still going to pay a premium for that real estate, but it's just real estate you couldn't acquire for the last 10, 20, 30 years.
Just to piggyback on that, I echo all of what Sean said, but I personally always take the philosophy, whether it's real estate or stocks, which I also invest a lot in, is I'm a big believer in buying what I know, but buying what I understand. And that goes down to not just, the location and the real estate fundamentals, but also the tenants. I got to believe in the longevity of this tenant. In the same way that I picked retail as a product type to work, I did it because I understood it. I patronize these places, whether it's a Chipotle or a Starbucks or, I might not say patronize a Family Dollar, but I believe in that concept. And I think that's a very important philosophy for any smart investor to take.
Very good, gentlemen. Stick with what you know and make wise decisions based on those determining factors. No rash decisions when it comes to purchasing real estate. But this one's coming from a broker, so we got to give some love to fellow brokers on the call. Most of it have been on the investor side. So it says, obviously you're bullish on retail, but how are brokers able to give an opinion of value without better direction on many of the retailers, such as like nationals like JCP or mom and pops, and what are lenders, basing loan amounts on there? And then it's a two-part question. What happens if interest rates go back to the historic 6% or more, or even more?
One, it starts with asking a lot of questions. I said earlier that transparency is key in this market. It's key in every market, but you really have to know what's going on. So getting good, accurate information from owners is first and foremost. And then understanding your marketplace too. Are you looking at a $50 rent that is not replaceable, or are you looking at an $8 rent that even in today's challenge market is replaceable? So it's putting a lot of things together. Now that's what we do on a daily basis. We underwrite hundreds and hundreds of properties, and we always say it's more art than science. I can't tell somebody exactly where the market's going to play out, but when you know the market, you know the tenants and what's kind of happening out there by paying attention, reading on a daily basis, seeing how investors, when they're they themselves are talking to you about different properties. You know, activity breeds activity. You know, when you talk to 10 investors about a Walgreens, you pretty quickly get the sentiments and different vantage points as to how they're looking at that tenant. So then you got to put it all in a bucket, shake it up, and see what comes out. But it's a lot of questions.
Yeah, no, I mean, I think you have to ask a lot of questions, be more educated than you probably normally would, maybe a little bit more cautious as you're kind of underwriting different things as you're evaluating those.
But it's just gathering information. I mean, that's the cool thing about Austin. Our teams. It's a great thing about being at Marcus and Millichap, and also just having colleagues outside of our firm is activity and the ability to take one conversation and apply it to the next conversation is really the key to our industry.
Yeah, I mean, we as a team probably field no short of combined 5 calls a week from appraisers. And, you know, early in my career, I received those calls and I felt like it was just another solicitation, and it kind of frustrated me at first. Now I actually look forward to those calls. I welcome them. Appraisers are a wealth of information. You know, they oftentimes are looking for, you know, a lot of guidance and input from us. And, they reciprocate with information in the same way we provide it. So as Sean said, you know, asking questions, getting information. I think from a valuation standpoint, we are not in a market where I think we need to look forward. And I say that in the sense of like using comps. When you're in an environment where cap rates are going down, sale comps don't really matter. But now when we're in a market where, you know, to an extent we are trying to quantify risk, we are trying to quantify NOI and appropriate values, you know, what's on market and what you're competing against is important, but as are the recent comps, especially anything that has closed since lockdown began. I think that gives a very good indication of where values are and where investors' mindsets are. And, to Sean's earlier point, we have a mortgage brokerage division within Marcus and Millichap that provides us tons of data on lenders, on loan to values, on interest rates, amortizations, how lenders are perceiving the risk of one tenant versus another. It's just in a market like this, you cannot be equipped with too much information.
Excellent. Yeah, I started my career in mortgage and debt consolidation and amortization and stuff like that. But to your point before about always collecting intel and understanding, you know, like I think we could all say when we're earlier on in our careers, I think my head was a lot bigger than it is now. And now I'll take every piece of nugget and knowledge that I can possibly get it to use it to my advantage. So just so we have about 15 minutes left before the time expires today. So I think we're running right on course, gentlemen. It's been great so far. But Sean, you mentioned shaking it up all in a box and seeing what pops out. So we're going to ask both of you to look into your crystal ball a little bit and just say what type of changes or new trends do you anticipate happening in retail sector? We talked about a little bit development, but do you anticipate increase in or decrease in development, occupancy levels, and then we talked about conversions a little bit. Maybe not multifamily, but Austin, you talked about mixed use. So what, if you had a crystal ball, what do you see here in the next, 6 to 12 months?
6 to 12 months, it's all relative to how things progress with COVID. So, but I think I've said it multiple times, long-term perspective, long-term thought process is what's going to drive the market and, define the winners of our current situation. You mentioned new construction. I think new construction is going to remain in check. I think, everything we're hearing from our developer clients Our costs are not coming down, so costs are staying relatively high for new construction. For the obvious reason, with tenants still in a recovery mode, rents have not grown, and I don't expect there are going to be a lot of rent growth. Frankly, you're going to see probably tenants put a little more pressure on landlords to keep rents modest. So that too will keep new construction in check. I think what you are going to see is a continuation of what we saw before, and that's tenants like Starbucks who are in an inline position without a drive-through wanting to move to a drive-through. Chipotle is doing their new concept with adding drive-throughs, or really more of a pickup concept, but again, same idea, moving out of an inline position to that. So there'll always be some level of new construction, but I do think it'll be modest. And I do think because of that, as we do see a recovery, as we have the vaccine in place at some point in the future, that occupancies will start to shore up and even rise. A lot of these shopping centers are affordable rents, and they're in great locations. You just can't duplicate some of these corners, even though it's an older center.
Yeah, I share a lot of what Sean said. To one of the questions earlier that started, yes, we are bullish on retail. It's really hard to predict what the next 6 months are going to look like. I think the election is going to play a part in, a lot of investors' feelings as it relates to putting money to work or maybe staying on the sidelines. I obviously the biggest thing is the vaccine, and how quickly we get it, and then more importantly, how quickly it's distributed, and then just how people feel the reaction to it. I think what I take a lot of comfort in is that there's still velocity. There are still buyers that want to put money to work. Debt is still available, and I don't see interest rates really going anywhere. I mean, we didn't touch on that one gentleman's questions about interest rates maybe getting to 6%. That's not going to happen for a long time, in my opinion. The Fed just can't do it. I just don't see that happening. So I think we're going to be in a low interest rate environment for the foreseeable future, in my opinion, at least the next 12 months. So, I still feel good about the short-term outlook for retail. I feel great about the long-term. I think we'll be back to how we were pre-COVID before we know it. This is going to be a lot more short-lived than the Great Recession. And, I look forward to when we get back to kind of pre-COVID, just mindset.
Yeah, that'll be nice. And like Sean said, focus on the long term. When you're evaluating these type of decisions, and just so we can move on to the next topic and allow anybody else to jump in here before we wrap up today. What advice do you have for other brokers? Obviously, you guys have been very successful in your careers. There might be some that are just starting out. Maybe some you guys might have got into it right when the first crisis hit. But what advice do you have? One of my favorite parts about brokerage is it's a very relationship-driven business, just like real estate is, and that's like the thing that remains constant through all of this is just kind of relationships and how we kind of work with different clients. But any advice that you have for brokers that are listening to the call today?
Go ahead.
I'd say, so I started, as I mentioned, in July of 2007. And the general, consensus in our business is if you make money your first year, you're doing really well. I was not that lucky, and then the market collapsed. So, I do see a lot of similarities to the Great Recession as what I'm seeing right now. And the Great Recession, and I think Sean would agree with this, was the best thing that ever happened to me and to us. It weeded out a lot of brokers and a lot of competition. I think for those that saw it as an opportunity to talk to more people, get in front of more people, You'd be surprised. I think people want to talk more. They want to engage more, because certainly over the phone, because nobody's meeting face to face right now, or few are, that I think, we're having more success, having more substantive conversations with clients, building those relationships, as you said, because this is a relationship business. And, when the world starts to feel a bit more normal and return to a sense of normalcy and, transactional velocity, those people remember you because you were the one who were touching base, providing market information, providing, comps, et cetera, maybe an opinion of value, et cetera. So for, the brokers that are listening, yeah, we're looking at this as a much shorter lived, 2008, 9, 10, and we're doing the exact same things we did back then, which is, dig in and talk to more people.
Yeah. Don't try to be transactional right now. This is not a market that, you force transactions. This is a market where you share information, help people make good decisions. And
don't overprice property.
And be patient. I think new brokers in particular, they have to be patient. It's a relationship business, as you said, and it takes time to build those relationships and really earn that trust with clients that they want to give you the opportunity to sell their multi-million-dollar assets.
Excellent. Well, this has been great, guys. If there's anybody in Chicago or national, I highly recommend these two guys. Their team does exceptionally well, and I just know from working with them over the last few years that they always have the client's best interest in mind. And having said that, you do, I'm trying to think about the best way to do this. You do have somebody that would like you to share your emails. I don't know if I'm going to be able to capture their information. I do have their name, so I wrote it down here, but you definitely have a quick plug here. Do you guys want to share your email here? That maybe I can type it in the chat box.
Probably the easiest thing we could say is just go to our website.
Oh, yeah.
It's swpropertyadvisors.com.
swpropertyadvisors.com, and I got another email here, so I'll make sure I retain this. But that's all that we have for today. If we want to just hold another 60 seconds in case anybody else wants to ask a question. But Sean and Austin, this has been excellent. We appreciate you taking the time today, and appreciate the live audience who came in to listen and ask questions and participate. You're getting a bunch of thank yous in the chat. I don't know if you guys can see the chat or not, but thanks, guys. Thanks for.
No,
thank you. Thanks for having us. This is cool.
Yeah, we really appreciate it.
Yeah. Okay. We'll be in touch. Thanks, guys. We'll talk to you soon.
Thank you.
All right. Bye.
Bye.